In this video, I'll analyze the Q1 FY26 result and Concall of PN Gadgil Jewelers. So let's start with the company overview. So PN Gadgil is a B2C jewelry retailer mainly present in the state of Maharashtra and Goa. In total, they have 55 showrooms as of Q1 FY26. So that is the company overview. So let's talk about the result in Q1 FY26. So in terms of the revenue, X refinery sales grew by 30% in this quarter. Why we should not look at the consolidated revenue? Because in the last year's Q1 FY25, they had a refinery sales in that quarter, and after Q2 FY25, from Q3 FY25, they stopped that sales because that was a zero margin segment. So that is why they stopped that refinery sales from Q3 FY25, and that is why in this quarter that refinery sales has been missing. Okay, so that is why we should not look at the consolidated revenue. We should focus on the revenue X refinery sales. Okay, so X refinery sales grew by 30% in this quarter, and if we look at the 30% growth, I would say that is a very good kind of a growth, because if we look at the Gudi Parva, which is a very big festival in Maharashtra, Gudi Parva in the last year was in the month of April, okay, and this year Gudi Parva was in the month of March. So last year's Q1 there was Gudi Parva in that quarter, but in this year Gudi Parva is missing from Q1 FY26. So that is why I can say that 30% growth in terms of the revenue on a high base, okay, on a high base of Q1 FY25 is really good. I mean, it would have been 40-45% growth if Gudi Parva was in Q1 FY26. So in terms of the growth, in terms of the revenue, X refinery was really good because of the 30% growth. And in terms of Akshay Tritiya also in this quarter, Akshay Tritiya fell in the month of April in this quarter, and if we look at the Akshay Tritiya sales grew by 35%, and on that day they registered a sales of 140 crore, which is the highest ever single day sales in the history of PN Gadgil. So that is another good point. And if we look at the Gudi Parva also, which was in the Q4 FY25, Gudi Parva sales also grew by 40% in the last quarter. So that is why I can say that the 30% growth is not just 30%, okay, it could have been 35, 40, 45 even. So that is one very good thing. And in terms of the segment wise sales growth, in this quarter retail grew by 19% year on year, again mainly because of the absence of Gudi Parva sales. In the last quarter retail grew by 81%, okay, so the whole sales shifted to the Q1 FY25. So that is why retail sales, you may say it is looking little bit low, but again it could have been, like as I said, if we calculate year to date, that could have been 40-45%, okay. So that is one thing. In terms of the e-commerce sales grew by 125% in this quarter year on year. Franchise also grew by 110% year on year in this quarter, which is a very good kind of a growth. So overall the sales grew at a very good pace. Again I would say that that could have been better. because of the absence of the Gudi Parva. Obviously that happened. So in terms of the revenue, absolutely very good. If we look at their guidance also, they are guiding us for a 9,000 to 9,500 crores of revenue in FY26. And if we calculate that what kind of growth they would need to achieve that number, then if we take the Q2 FY26 to be flat in terms of the revenue growth, because obviously in the Q2 also there was a refinery sales in the FY25, but in the next quarter refinery sales is going to be zero. So in terms of that also we can say that for Q2 FY26 revenue at a consolidated level will be around zero. And one another thing we have to consider is that in the last year Q2 FY25 there was a custom duty cut. So we all know that because of that cut in the duty, the sales suddenly shot up, and obviously what happened we all know that. So that is why we can expect Q2 FY26 at a consolidated level revenue we can expect less than 0 or even 0% growth in terms of the revenue. Okay, so that is what we can expect in the Q2 FY26. And if we consider that, then in the H2 FY26 they have to grow at a level of 40-45%, which is I could say that which is achievable absolutely, because if we look at the year to date the revenue growth for PN Gadgil, I mean Q1 FY26 plus Q4 FY25, if we combine these 2 quarters revenue growth, then the revenue grew by around 40% year on year. So in terms of, if we look at the pace they are growing around, they can easily achieve that number of 9,000 to 9,500 crore. So that is one point. So the guidance looks absolutely achievable, because if we look at the past quarters also, they have been growing at a rate of 40-50% in terms of the revenue. So absolutely I do not see any kind of a problem in terms of the achieving that number. So that is the thing with the revenue. In terms of the SSG, in this quarter SSG was little bit low, mainly because of the absence of the Gudi Parva sales. SSG was at 8% in this quarter. So in terms of SSG also I do not see any kind of a problem in that number. And if we look at their footfall, then in this quarter footfall increased by 25%, which is very very good, because if we look at the gold prices, it is around 1 lakh rupees. After that, if you can grow your footfall by 25%, it is amazing. And if we look at their conversion ratio also, in this quarter conversion ratio is at 92%, which is, I mean, amazing. I can say it, because what is conversion ratio? That if 100 people are coming in your showroom, 9 out of those 100 people you are converting 92 of them to the sales. So that is what conversion ratio is, and that is why the 92% conversion ratio is really really good, and that is what gives me the confidence that yeah, they can grow outside of Maharashtra. Okay, so that is the point. And if we look at their plans in terms of the expansion of the geography also, if we look at, then they are going to open 3 showrooms outside of Maharashtra in this quarter Q2 FY26. One will be in Indore, Madhya Pradesh. 2 will be in UP, one in Kanpur and one in Lucknow. So that is their plan, and in that way they can open many more showrooms in that region, in that northern and central India. So that is their plan. So if I discuss more about their plans in terms of the showroom, then they are going to open 9 showrooms in this quarter, Q2 FY26. So at the end of Q2 FY26, the showroom number of showrooms will be around 64. Okay, so that is their plan. In terms of the whole year FY26, they are going to open 25 showrooms in the whole year. So at the end of this year FY26, the number of showrooms will be at around 75 to 80. Okay, so that is the thing. And what is their plan going forward in the FY27, FY28? They are saying that in the FY27 also they are going to open another 20-25 showrooms. So at the end of FY27, the number of showrooms will be at 100, and then in the year of FY28, the number of showroom will be at 150 at the end of FY28. So that is their plan, and that is a really good kind of a plan if we look at it, because in this year the expansion rate will be around 50%. If we look at Kullan also have a plan of 40-45% expansion rate. So in terms of the expansion rate, PN Gadgil is up to the mark at 50%, and going forward over next 3 years they are going to open another 100 showrooms. So that is a very good kind of a plan if we look at. So that is the thing. So they are planning to increase their showrooms by 3x in the next 3 years, which is a very good kind of a rate of increase. It is going to be around 50% CAGR over next 3 years. So that is a very good kind of a expansion plan, and obviously the incremental expansion will be in the states of northern India and central India outside of Maharashtra. Obviously that is the thing. And what they are saying about the FOCO COCO, 50% will be FOCO. They are in the FOCO model, the investment is 0, and another 50% will be from COCO model. So that is their plan in terms of the capex. In terms of the lifestyle and full-fledged PNG showroom, 50% will be lifestyle and 50% will be PNG showroom. So that is one another thing, and that is the plan they have in terms of the expansion, which is very good, I can say it. In terms of the capex and capital requirement, obviously 50% showrooms will be in the model of FOCO, so there will be no investment. In terms of the COCO showrooms, in terms of if we look at their PNG full-fledged showroom, that would need around 50 crore per showroom, and lifestyle stores would need around 10 crore per showroom. So that is the capex amount per showroom. So we can expect capex of 1000 crore in those 25 showrooms. Okay, so that is the capex that is the capital they would need to open those 25 showrooms in over next 2 years. And what the management is saying about the equity raising, the management is saying to open those 50 showroom, I mean COCO plus FOCO, they have the money. Okay, they have the money to open those 50, to capex those 50 showroom, and they would need extra capital after FY27. Okay, so that is one thing the management is saying. So we can expect a QIP after FY27. So that is one thing about the capex and capital requirement. So to open next phase of 50 showroom, they would need zero outside, I mean external capital like QIP. So more or less they will use some debt, and they have the cash in their bank, and obviously the profits will be there. So that is the capex and capital requirement for opening next 50 showrooms. So we can expect a QIP after FY27. So that is the thing we have to keep in our mind. In terms of the strategy outside of Maharashtra, what strategy they are following, the management is saying that they have already done some kind of a exhibition to know the customer behavior in those states of UP, Madhya Pradesh and Bihar. So the reviews are pretty good from the customers, and they are confident about their expansion in the states of UP, MP and Bihar. So that is one thing. In terms of the strategy, they will keep around 70% inventory for the local designs. So that is the strategy they will follow, and 30% will be for the evergreen PNG designs. So that is the strategy they will follow in the states of UP and MP. So that is the thing. In terms of the break-even time, if we look at the showrooms in the state of Maharashtra, the break-even time for those showrooms are around 12 to 15 months. But for the showrooms in UP and Madhya Pradesh, they are expecting a break-even time of 18 to 20 months, which is obviously very normal, because they have a very good brand presence in the state of Maharashtra, and they will not have that in the state of Madhya Pradesh and UP. That is why we can expect a expansion in the break-even time. Obviously, that is very normal. So I do not have any problem with that. So we have to track that how those expansion is going to happen, how they can help company to grow their sales, grow their profit. So that is what we have to see. So we have to track that quarter on quarter basis. So that is the thing with the break even and the strategy of the newer states. In terms of the gross margin, in this quarter gross margin improved by 500 bps year on year, mainly because of the absence of refinery sales, because as we know that refinery sales is a zero margin business. So that is why the gross margin improved by 500 bps in this quarter. If we look at the quarter on quarter number also, quarter on quarter gross margin improved by 120 bps, which is a good kind of a growth. Okay, so in terms of gross margin, the improvement is there. And in terms of the and if we look at their improvement in terms of the gross profit margin also, they have been very consistent in terms of the improving their gross margin. So that is one another good point in terms of the PN Gadgil, and we can expect that gross margin to improve further, mainly because of the start ratio. When in the time of their IPO, the start ratio was at 8%, whereas if we look at the current start ratio, that is at 10%. In this quarter, start revenue from studded jewelry grew by 40%. Okay, so that is a very good kind of a growth, because within less than a year, they have been able to improve start ratio by 2%. Okay, I mean from 8% to 10% within a year. So that is a very good kind of a improvement in terms of the stud ratio. And if we look at the margin difference between the studded jewelry and non-studded jewelry, studded jewelry has a margin of 33%, I mean the gross margin, whereas if we look at the normal jewelry, non-studded jewelry, then the gross margin is at 7 to 9% range. So that is why as the stud ratio is going to increase, obviously the gross margin is going to increase, and the management is guiding us for a 13% to 14% stud ratio by FY27. So here we can expect a very good kind of a improvement in terms of the gross margin, but the management is saying that they are expecting a gross margin of 13 to 14% in the FY26. So obviously I think that is more of a conservative guidance they are giving. And one another thing we have to look at, as they opened lifestyle segment. So if we look at the product of lifestyle showrooms, they mainly sell 18 karat, 14 karat and studded jewelry from those showrooms. So as the revenue from lifestyle showrooms is going to contribute in the whole revenue, obviously the gross margin will be better. Okay, so there is two different triggers of the gross margin improvement. Is the improvement in the stud ratio from their full-fledged PN Gadgil showroom, and one another is the lifestyle showrooms. So that is the two triggers they have in terms of the margin expansion. So that is the thing with gross margin. We can expect a better gross margin going forward. So that is the thing. So in terms of the PAT, in this quarter they grew their PAT by 96%, which is a very good kind of a growth. And in the last quarter also in this quarter the PAT grew by 96%, is a very good kind of a growth year on year. In terms of the margin also, PAT margin improved by 19 bps in this quarter, year on year level. And in this quarter the PAT margin is at 4%. Their earlier guidance was a PAT margin of 3.25 to 3.75, if I am not really wrong. 2.75 to 3.25. They gave the guidance in the Q4 FY25, but the management is now saying that they can easily do a PAT margin of 3.5 to 4% going forward in this year. So that is one guidance the management is giving, and already the PAT margin is at 4%, which is a very good kind of a thing. So we can expect this PAT margin to be around this level only. So that is one point with the PAT margin, and the guidance is 3.5 to 4% now. So that is the thing with the PAT margin. So in terms of the whole business, in terms of the result, it is a very good result. I mean very good. I think they can easily achieve their guidance of 9,000 crores of revenue in the FY26. Also they can easily achieve that 4% of PAT margin if everything goes in the right way. And one another big thing is that they are started expanding outside Maharashtra. So that is one another thing we have to track, because it is a absolutely new thing, new strategy for PN Gadgil, because for their lifetime they have been a company, they have been a jewelry company for Maharashtra only, and that is the first time they are going to expand outside of Maharashtra, and that is why we have to keep tracking that thing. But I think there should not be any kind of a problem, because as we can see that in Maharashtra they have a conversion ratio of 92%, which is a very good kind of a conversion ratio. So that is one thing. So in terms of all the things, I can say PN Gadgil is moving in the right direction. If we compare PN Gadgil with Kollan also, then obviously if we look at Kollan is growing at a rate of 30, 35, 40%, whereas PN Gadgil is growing at a 40, 45%. And if we look at the base, Kollan has a bigger base, PN Gadgil has much smaller base. But again, I would say that both company are doing really well. So PN Gadgil is also doing very well, and if we look at their past few quarters, they has been doing really well. Kollan also has been doing really well. So in terms of these two company, both of them are very good. Kollan can grow at a rate of 30-35%. PN Gadgil also grow at a rate of 40-45% easily. So that is the thing with these two companies. In terms of the valuation, PN Gadgil is trading around, I think, 30x PE. I think if they can able to grow at a rate of 40-45%, the rating can happen in the future, obviously, no doubt about that. Because if a retail company, if a B2C company can grow at a rate of 40-45%, they can easily get a PE of 80-90%, 90x. Okay, if we look at the Kollan's PE also, they are growing at a rate of 30-35%, and they always have been a 35-40% growth engine. And if we look at their PE, they always have a PE of 70, 80, 100x. So obviously, if PN Gadgil can grow at a rate of 40-45%, obviously they can easily get a PE of 60-70x. So that is what I think about the PE. Obviously, I am not giving any kind of a buy and sell recommendation, but obviously there is a chance of rating in PN Gadgil, and overall as a company they are doing really well in terms of the whole B2C jewelry segment. If we look at other players, PN Gadgil and Kollan have been the best. Okay, so that is the thing with the PN Gadgil. So that's it for the video. Thanks for watching.